Hi, everyone. I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our January 2026 update, which we're calling Managed Futures Are Here to Stay on the I Am Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. Regarding the title, it refers to a recent Morningstar Q&A write-up on managed futures and DBMF that Andrew did, which is linked to the email that accompanied delivery of the video update. It's one of the best quick hit pieces we've seen on the space and the strategy in a long time, so I hope you'll check it out. Well, what a January. Actually, what a 2026 so far. Not sure we've seen this kind of across the board macro volatility to kick off a year in a while, but I'll leave that commentary to Andrew. But before I hand it off, I'd like to give folks who watch our monthly update videos a sneak peek of some content we'll be releasing soon in a new 5-minute animated video tentatively titled The Essential Alternative, which makes the case that if you're allocating to alternatives, managed futures is a cornerstone, must-have component of any truly alternatives allocation. It's a drum we're going to keep on beating because we believe it needs to be heard. So on that point, what you're looking at here is a simple scatter plot showing correlation to US equities on the x-axis and alpha generation on the y-axis. The dots are all of the Morningstar liquid alternatives category averages. You'll see, with the exception of equity precious metals, most of these quote alternatives unquote are highly correlated to stocks, not delivering much diversification benefit at all. And most display negative performance traits in terms of alpha generation as well. So while adding alternatives to portfolios sounds good in theory, it can be very difficult to pull off effectively. Now, take a look at where managed futures, as represented by the SGCTA Managed Futures Index, shows up. Low correlation and high alpha generation compared to all of these various alternatives. Managed futures delivering both absolute and relative performance coupled with real diversifying benefits. The video that we're going to put out will dive much deeper. It's going to compare managed futures to all major asset classes in terms of historical performance, alpha generation, drawdowns, Sharpe, etc. And I think you're going to find that it makes a really strong case. So that's it for the intro. Let's get over to you, Andrew, for your take on January and other thoughts.
Thanks, Mike. So on the macro front, big changes are afoot. The signs of a rotation out of U.S. assets are hard to ignore. Developed and emerging international markets outperformed U.S. equity markets by a lot in January after roughly doubling the performance of the S&P 500 last year. The euro is up 15% against the dollar over the past year, and gold soared another 12% in January after soaring more than 60% last year. These global shifts are generating powerful trends across asset classes that we've seen in DBMF with a 25% jump since the post-Liberation Day lows last year. In January, DBMF rose approximately 4%, nearly matching the performance of the SocGen CTA index, which rose 4.7%, a month that ranks in the top decile over the past 25 years. The Morningstar systematic trend category did even better at over 5%, continuing a trend, pun intended, of mutual funds and ETFs awkwardly outperforming higher cost hedge funds. Let's hope the start of 26 is a sign of a very, very trendy year. So here's our performance since the launch of DBMF in 2019. Over more than 6.5 years, we've added more than 350 basis points of returns per annum relative to the SocGen CTA index, with more than double the Sharpe ratio and a correlation of nearly 0.9. Outperformance relative to the Morningstar category is even higher. The live strategy track record back to July 2016 shows similar results. Now, what we believe the data shows is that commodity trading advisors, more commonly known as CTAs, generate a very valuable signal, sometimes early and contrarian information about big shifts in the macro landscape, but that high implementation costs erode performance. On virtually every statistical measure, investors would have been better off replicating hedge fund returns over the past decade rather than investing in hedge funds, or for that matter, mutual funds. Now, a rational allocator should take a step back and think about what this means. The logical conclusion is that replication should serve as the core of the CTA allocation, efficient beta, so to speak. It should be the easy part of the allocation. Then allocators and fund selectors can concentrate their energies on quote unquote satellite single managers that are not beta adjacent, but rather offer truly differentiated returns. Now, if interested in discussing this live, please do not hesitate to reach out. So here's our slide on volatility adjusted positioning. The green bars are the volatility adjusted exposures of our 10 futures contracts at the end of January, and the red dots are positioning at the end of December. Moving from left to right, in commodities, we continue to be long gold. The de-dollarization trade is in full swing and have shifted to long crude oil, perhaps a nice hedge if the Middle East tinderbox reignites. We're long the euro, albeit dialed back that position, and still meaningfully short the yen. More of an idiosyncratic bet on the unwind of Japan's three-decade financial experiment than a bullish view on the dollar. We have minimal risk on the rates front, likely a reflection of the lack of clear direction in those markets. And lastly, we significantly increased exposure to both EFA and EM with a hedge by shorting the S&P 500, pressing the bet on the ongoing rotation from US equities. And finally, here's overall contribution to performance. Now, not surprisingly, gold and non-US equities drove performance last month, and we gave back some of those late 2025 profits as the yen bounced a bit. Now, with that, I'll hand the baton back to Mike.
Okay, thanks, Andrew. So let's wrap up here with long-term performance numbers for DBMF. Annualized return since inception, including the month of January 2026, is now 8.79%. That's ahead of the SocGen CTA index by over 360 basis points annualized. And it's also ahead of the Morningstar systematic trend category average by over 465 basis points. And long-term outperformance against the traditional diversifier for equities, that being bonds as represented by the Bloomberg AG, remains very well intact. DBMF outperforming by over 715 basis points annualized. So thanks everyone for checking out our monthly videos. As always, if you have any suggestions in terms of things you'd like to see, changes, feedback, or inputs, please let us know. Otherwise, if you have more questions about the strategy or would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.